Infinity Capital, trusted partnerships, proven results. Welcome to our investor education series. Today's topic is understanding investment partnerships. Understanding investment structures and partnerships is essential for evaluating any real estate opportunity. Before looking at projected returns, investors should understand how a deal is structured and how decisions are made throughout the life of the investment. The structure determines not only how profits are shared, but also how risk, responsibility, and incentives are aligned. One of the first questions investors should ask is whether the opportunity is an active or passive investment. In most multifamily partnerships, investors participate passively, while the general partner manages acquisitions, financing, operations, and the eventual sale. Understanding who is responsible for what, and how much control each party has, sets clear expectations from the outset. Investors should also understand the roles of the general partner and the limited partners. The general partner is responsible for executing the business plan and making operational decisions, while limited partners provide capital and share in the results. A well-structured partnership aligns incentives so that the general partner is rewarded for long-term performance, not just for closing a deal. Another important area to evaluate is how investors are paid. This includes understanding distributions, preferred returns, profit splits, and the timing of cash flow. Investors should ask how income is generated during the holding period, how often distributions are made, and what happens to cash flow if performance differs from projections. Fees are another key topic. Investors should ask what fees exist, what they cover, and when they are charged. Fees are not inherently negative, but they should be transparent and reasonable relative to the services being provided. Understanding fees helps investors evaluate net returns rather than focusing only on headline numbers. The holding period and exit strategy are also critical considerations. Investors should understand the intended length of the investment, the conditions under which a sale may occur, and how proceeds are distributed at exit. Asking what happens if market conditions change helps clarify how flexible the strategy is and how decisions will be made over time. Risk management is an essential part of partnership evaluation. Investors should ask how downside risk is assessed, how conservative the assumptions are, and what safeguards are in place, such as reserves or debt structures. Understanding how a partnership plans for underperformance is often more important than understanding how it plans for upside. Communication and transparency are equally important. Investors should ask how often they will receive updates, what information will be shared, and how performance will be reported. Clear and consistent communication builds trust and allows investors to stay informed throughout the life of the investment. Ultimately, strong real estate partnerships are built on alignment, clarity, and discipline. Asking thoughtful questions about structure, incentives, risk, and communication helps investors make informed decisions and set appropriate expectations. This educational overview reflects how we think about investment structures and partnerships at Infinity Capital. Click subscribe and visit www.infinitycapinc.com to learn how we can help you on your real estate investment journey.